You've probably heard the term DSCR loan all over social media lately. Everyone's calling it the secret weapon for real estate investors. But what actually is it? And how do you use it to start building wealth, even if you don't have a W-2 or any kind of traditional income? Well, stay tuned. I'm breaking down exactly how DSCR loans work, what lenders look for, and why they've completely changed the game for real estate investors in 2025. I'm Mike Ratliff. I'm a mortgage advisor based in North Carolina that specializes in investor financing. I help real estate investors all across the state structure smarter financing, scale their portfolio, and make their money work harder for them. So, if you're serious about growing through real estate, hit that follow button. I'm going to drop one new investor video every week starting now. Okay, so what exactly is a DSCR? Let's start simple. DSCR, simply put, stands for Debt Service Coverage Ratio. What that really means is, well, it's just a fancy way of saying, can the rent cover the mortgage? Yes or no? With traditional loans, banks want to see your personal income, your pay stubs, your tax returns, and your W-2s. But how DSCR loans differ? They don't care about your job. They don't care about your income. They care about the property and that property's income. If the property's monthly rents cover the monthly mortgage, taxes, insurance, and HOA if there is one, you can qualify. Even if you're self-employed, retired, or running multiple side hustles. We all know a lot of people these days that do that. That's why investors love it. It's a cash flow based loan, not an income based loan. Most lenders use a very, very simple formula. DSCR equals gross rent divided by total monthly payment. If that number is 1.0 or higher, meaning the rent covers the payment, you're in great shape. Some lenders even allow below 1.0 for really strong borrowers. That's where an experienced mortgage advisor, like myself, makes a huge difference. So, who is this type of financing for? Well, it's designed for real estate investors, not owner-occupied homes. So, if you're buying a rental property, a short-term rental, or adding to your rental portfolio, this could be your go-to option. It's also perfect for self-employed borrowers who write off a lot of income. Again, as long as it's not owner-occupied. New investors who haven't really built a long history yet or are just getting started. Experienced investors who want to scale faster without a whole lot of paperwork. You can use the DSCR loans for purchases, cash out refinances, or rate and term refinances. That's huge because now you can buy, improve, and refinance without waiting for traditional underwriting headaches. And yes, some lenders that I work with have no title seasoning, or as little as 90 days before you can do any of the DSCR cash outs or refinance options. That's how people are recycling their equity faster and building that portfolio. But hey, there's always a catch. So let's talk trade-offs, okay? With flexibility comes a few differences. Down payments typically anywhere from 20 to 25% down. Rates are typically slightly higher than conventional loans, but not by much. And right now they are very, very similar as far as rate. And as far as reserve requirements, lenders often want a few months of payments saved up. That could be anywhere from 6 months to a year. And then there's the math. If your rent is low or your mortgage is high, that DSCR ratio could drop, which means a higher rate or possibly more down payment. Okay? That's why it's very, very important to analyze all deals before submitting any kind of offer. Here's a quick pro tip. If your property doesn't quite cash flow, look at short-term rentals or multifamily options to boost that rental number up. Okay, hopefully you're still with me, but let's use a real-world example and just kind of give you an idea of what I'm talking about. So let's say you're buying a property for $250,000. Well, let's say that monthly payment, principal, interest, taxes, and insurance comes out to $1,900. If you can rent that property for $2,000 a month, that is a DSCR ratio of 1.05, and that will likely qualify with no problem. No W-2, no tax returns, just the lease or market rent schedule. That's how new investors are getting into the game every single day. Now, let's recap. DSCR loans let you qualify based on property cash flow, not any sort of income from you. They are perfect for investors of all levels, especially those with multiple properties or very complex income structures. Lenders care about rent, reserves, and property type, not your employment or your income. And with the right structure, you can use these loans to scale your portfolio faster than ever before. If this helps you understand DSCR loans just a little bit better, do me a huge favor. Follow for more investor tips and drop a comment if there's a specific investor topic you would love for me to cover. Next week, I'll be diving deeper into advanced DSCR strategies, so make sure you hit that follow button so you don't miss it.